Dear viewers, welcome to yet another edition of Your Life, Your Money. What did we see in the stock markets in the month of July? Every day, starting from first week of July, we started seeing Indian stock markets making new lifetime highs, creating peak after peak, day after day. What should you do? Should you invest during the market peaks or you should stay away from the markets? In this episode, I'm going to examine every point that you have to keep in mind during these times. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, we are passing through the market peaks. What should you do? Should you commit more money and participate in the market? Or because market is at high, you should shy away and stay away from the markets? What's in your best interest? Is there a specific answer I can give for you? Unfortunately, there is no easy answers around that. When the markets are making a peak, the judgment is called for. And when I say judgment, the answer could be at sometimes you must invest in a peak. And the answer could be sometimes that you should not invest during the peak. And sometimes the answer could be invest less or invest more during the peaks of the market period. I'll help you with the example now. In the year 2003, the Sensex was at just 3,000. And within a short span of time, before 2004, the markets climbed to about 5,500. Yes, in the year 2003, the market was at about 3,000, and by 2004 end, it was somewhere around 5,500. Markets moved up by 50%. Markets have made a lifetime highs. They were moving with extraordinary pace on the upside. Had you not invested in the market at that time, you would have felt left out. What happened subsequently? Subsequently, from 2003, which was at 3,000, the markets went on to climb a level of 21,000 on the Sensex by the end of 2007. Unheard of, right? That's the madness of the market. How markets will behave at what points of time can never be fathomed. If you are glued to the idea that you should not invest during the market peaks, then you would have lost the benefits of the best bull markets we have seen during our lifetime. I'll tell you another case in point now. I told you about the case of missing the bus, but I'll tell you one more case. Now, if somebody has invested in stock markets during 21,000 on the Sensex, what happened subsequently is nerve breaking. The markets corrected from 21,000 and went back to 8,000 all the way down in less than 1 year. Had you invested during the peaks of 21,000 on the Sensex, then you would have become heartbroken. You would never ever come back to the stock market during your lifetime. You say, this is not my cup of tea. I explained you both the cases. In one case, you invested during the peak and you could rake up a lots of money out of it. And in another case, you invested during the market peak and your lifetime assets could have been destroyed by the wrong decision. How should an investor take a decision? I still remember my journey during that period. When I gave a call around June of 2007 when the Sensex was at 18,000, people called me a madman. People said, you know nothing about the stock market. People said, my own clients at points of time said, had we taken your advice and not invested further on, we would have lost so much of our money because market doesn't listen to my advice. Market doesn't listen to my judgment. Market will do what it needs to do. From 18,000, markets climbed all the way to 21,000. But subsequently, what happened? From 21,000, it dropped down to a level of 12,000 and then to around 8,000 levels. This is what happened. So, there are no right and wrong answers. The judgment is required at every stage. This is one area where your financial planners, especially the experienced one, give you the right calls. It is impossible for a do-it-yourself investors to go through all these gyrations and find out at what stage of the market it is, whether it makes sense to commit more money, whether it is better to exit the market. I don't think a do-it-yourself investor is able to take that call. Experienced planners can definitely take a call. I recently remember looking at one of the comments made by One viewer, he said, when I see Tesla moving 3 times in 6 months, that gives me an indication that the Tesla stock is going to fall. He could be right, he could be wrong. What if Tesla were to climb 10 times higher from there? Market's madness is not known. So there are no direct meters to measure at what stage the market will stop, at what stage markets will fall, or to what extent it can climb higher up. Now let us look at from a planner's perspective and see how a planner will think, how an analyst thinks, at what stage of the market we are in, and help the customers figure out should they commit money during the market peaks or stay away. Let's look at these points one by one. The first point we have to look at is where is the peak getting formed? Is it the peaks are getting formed all over the world? That means in every indices of the world, you are seeing it as a bull run across the globe, or you are seeing in some pockets. Which country you are seeing these bull markets being formed? Where the peaks are getting formed? Is it the US or is it India? Is it China? Is it Japan? If you are seeing the peak getting formed in any single country, then that country has a story to tell you, and you have to dissect that story and decide should you invest in that market or not invest in that market. So again, there is no easy answers. It has to be probed properly and arrive at a proper decision. See, today you see India is going through a peak formation, but whereas the US is below the previous peak, it is evident that it is not happening across the globe. Yes, across the globe, the stock markets have moved up, but they are not in the same stage. In case of US, they are shy of previous high. Only Dow Jones, which is very closer to the previous highs, but if you take S&P 500 or Nasdaq, it is well below the previous lifetime highs. So a judgment has to be drawn from in which country it is making the peak and what needs to be done. No easy answers here around. The second point that you need to consider is when is the peak getting formed? Now, if you look at a market and if the markets has spent enough time doing nothing, we call it as consolidation phase, we call it as time correction phase, we call it a period of a bearish market or markets not doing anything, markets in a lull period for a prolonged period of time, and then the markets will conquer the previous highs and they start making new peaks day after day. Such markets have to be invested. So they have spent enough time, all the things that has to happen, like economy catching up or the excessive valuation which was there has been taken out, the markets have come to the reasonable valuation, then the peaks are forming. Such peaks have to be invested. Whereas if a market suddenly makes a climb, it market falls for some time and quickly regains the peak, then evaluation of that market will be required. So the stage of the markets will decide should you invest in the market peaks or not. Another point that you need to be considering is if you're seeing markets are making lifetime highs or the peaks, you should find out how long the bull market is persisting. A peak is just not formed, you just don't say that it is at the peak. A bull market is always characterized by new peaks getting formed at regular intervals of time. Let's say that it started 5 years before and every year you see new peaks are getting formed, then you say it's a prolonged bull market. If the bull market is very prolonged, it requires introspection, it requires a proper judgment. Is the valuations are very high? What is driving the market? See, bull markets by and large, it is safe to say, will last for a period of 3 to 5 years. Once it gets started, 3 to 5 years, they will mature and they'll go for deep correction. That's what happens in the marketplace. If you see a bull market has just started, then you see a peak, then you should not be hesitant. Rather, you should commit money at that time and ride the bull market. But if the bull market is persisting for a longer period of time, then the judgment will be required. So you can't be putting a disproportionate amount of money into the market during such market peaks. One clear indicator which you can look during the market peaks is what is the volumes of trades that are happening in the stock marketplace. A market which is making the peaks with large volume of trade is a safer market. That means there are more people, there is more money chasing, there is a wider interest, and people have enough money to fuel that bull market. If you see a peak getting formed with large volumes, it is better you participate in that bull run and ride the peak. On the contrary, if you see the peaks are getting formed with lesser and lesser volumes, then it is a dangerous situation. Again, I'll go back to the period of 2007 to help this case. During the period of 2007, particularly the second half of 2007, what I observed was market is making new peaks, but the amount of trades which are happening in the market is lesser and lesser. What does it indicate? It indicates people do not have enough money. Yes, everybody wants to make money during a bull market, but people do not have enough money. That's why more people are not coming into the stock market. But even less amount of people coming into the market is pushing up the market. Why? Because there are no sellers in the market. People who have bought stocks in the earlier times will not sell it because they expect the market to rise to a further level. This is exactly what I have observed when the Sensex has reached 18,000 during the second half of 2007, and I had given an exit call at that particular time. What happened subsequently? A time will come, within a short span of time, people will completely run out of money and there will not be any trade. And there will be a rush to the exit doors, and that will bring down the stock market. That's precisely what happened in the year 2008, January 15th or 16th around. Markets dropped all the way from 21,000 to 18,000 in no matter of time. So you had everybody trying to sell, you had nobody to buy, and markets will fall like bottomless pit. Another indication which you can get is from the trader's margin or a jobber's margin. When the stock markets are functioning, you have buyers and you have sellers, and you have got the jobbers or people who buy and sell and help give a liquidity to the market. So they sell at a higher price and they buy at a lower price. So normally if you have a stock, that stock sells for a higher value and buying will be lesser. This is called a jobber's margin or a trader's margin. That is what traders make from the sale. But the traders know when the markets are climbing very high, the risk is increasing. So this gap between the buy and sell difference constantly keeps on widening. This is another indicator which I had picked up during the 2007 bull market. The difference between the buy sell was unbelievably high. That gave an indication that market is going through a terrific risky procedure and it is not safe to stay in the market. So look at the jobber's margin. You should be used to seeing these margins on a day-to-day basis, then only you can make out. Otherwise, it doesn't make any sense for you to look at the difference from this. But a professional will definitely look at these cues and decide what could be the stage of the market. The next point you should consider is, what is the valuation of the market? A bull market corrects when the valuations are stretched. I have spoken in multiple videos earlier occasions. When the Indian stock market, the PE ratios tend to move towards 30. When it is between 28, 29, 30, we are very close to a correction phase, and it has happened multiple number of times. So if the PE valuations are going towards 28 or above, it's an indication that the markets are about to correct. Investing further money into the stock market at that point of time can create a disaster in your life. What if you are investing at a lower valuation? Now, 2 years before, October 21, we saw the PE stretching to about 29 to 30 on the Sensex. But today, the same PE is at about 22 or 23 on the same Sensex. So in 2 years' time, there is a cooling off of the valuation of the market, and market has become more safer today. So the valuation dictates or gives you a hint whether you should invest in the market peaks or not. So constantly keep looking at what is the valuation suggesting for you. Is it safety or is it risky? Dear viewers, I have a question for you. Most people invest in Indian stock market and the US stock market. These two markets are giving you two different stories today. As I said, Indian market is making peak day after day, and the US market is still shy of the previous peaks. I would like to hear from you. If you have to choose between these two markets, the US market and the Indian market, where will you invest today? Please substantiate with the reasoning. I am looking out for your answers. Leave your answers in the comment section below. Now, before I conclude this topic, let me also dwell on a few other points that you need to be knowing. The reason behind why markets are making lifetime highs or why markets are making the peaks in the stock market. If you know the reasons why market makes peaks, then you can also know the reason why you should invest or why you should stay away from the market. The first reason is markets make peaks because markets see the growth happening. If market gets a hint that the growth is as per normal, or there is an acceleration of growth, or there is a hope that the growth will increase in future, markets will climb up. So if you are getting the cues that the growth are far better, then if your markets are making peak, it is advisable that you invest in such a market. Now, what do you see in Indian market? Indian markets, you saw that the GST collections are high, the advance tax numbers are high. Every number that is coming from Reserve Bank, IMF, World Bank is everybody is telling India is growing at a tremendous pace and the world is dependent on India for the world growth. So it is a positive news. That is why the Indian markets are making a lifetime highs and it has just started. So it's a positive sign. What other reasons will contribute for market making peaks? The second reason, the most important reason, is the liquidity in the market or the supply of funds into the market or credit into the market. If you take the US market, most of the gains in the US markets have come because of a liquidity infusion into the US market. That means Fed has printed a lot of dollars and it has infused into the market. That is finding way into the stock market, and that's why during the last decade the US stock market climbed to lifetime highs because of this liquidity infusion. It is not because of excessive growth or very attractive growth. Yes, growth was there, but the real reason behind the US market climbing to that level is the liquidity push. What happens if liquidity is driving the market? The day the liquidity is being withdrawn, the fuel for the market disappears and the markets are ripe to fall from those levels. Tell me from your experience or what you have observed or what you have heard on the television, what is that the United States is doing today? Is it infusing liquidity into the market or is it withdrawing the liquidity from the market? What could market do because of this particular action? I'm listening to you. Leave your opinion in the comment section below. Two other factors which can drive the markets climbing newer peaks are inflation and the interest rates. They are interdependent, and these central banks of the countries will use the interest rates to speed up the economy or accelerate the economic activity or curtail the economic activity. If the interest rates are very high and because of which economy has cooled down, in the next phase the central banks will bring down the interest rates and that will kickstart an economic cycle in the country. So if the interest rates are very high, what can probably happen next? The next course of action is the interest rates will cool and they will come down. So it's an indication that markets are about to climb further high up because they take cues from the interest rates. Likewise, if the inflation is rising in the economy, to curtail the inflation, the central banks will raise the interest rates. So the economic activity, when it gets too much accelerated, results in an inflation in an economy. To control that inflation, central banks will rise the interest rates. The rising of interest rates will result in application of brakes into the stock market. So you have to very, very clearly identify at what rate the inflation is today, what is the trajectory of inflation. Because of inflation, how will the central banks react? Will it increase the interest rate or will it decrease the interest rate? If inflation is rising, the next action of central bank is increasing the interest rate. If inflation is falling, the next chance that the Reserve Bank or any central bank takes is the interest rate moderation, or it will move the interest rate towards the down cycle. So what do you think? Where is the interest rates today? I personally feel interest rates have peaked in India for sure. Very, very unlikely that the interest rates will climb up from here, but interest rates are likely to come down in months and years ahead. Only caveat here has been that in case the US central bank increases the interest rates on dollars, then as a competitive measure, the Indian Reserve Bank may increase the interest rates. Otherwise, the chances of interest rates falling down in India is very, very real. Dear viewers, I have told you the multiple points that you have to consider while you decide should you invest during the market peaks or not to invest during the market peaks. I'm very sure I've discussed too many points and I'm leaving you confused. Don't worry. In case if you're confused, help is at hand. We are there to help you. We have team of experts on the ground who can help you to decide the best investment strategies, the best plans, and the best place where you can invest. You can reach out to us through a WhatsApp message on the number that is given here in the description box below, or we have just given a link over there. Click on the link that will take you to your WhatsApp, and from there you can reach out to us, and our team of experts are ever ready to help you design your investment strategies as per your risk profile. Don't hesitate. If you need the help, send that message now. Dear viewers, hope the video that I have done today helped you to understand should you invest during the market peaks or not, and when should you invest during the peaks and when you should not. If it did help you, give me a thumbs up. Do not forget to share these videos with your near and dear ones and friends and relatives. If you are a person who is watching my channel for the first time, or if you are yet to subscribe for the channel, please do hit the subscribe button now and press the bell icon. So thank you very much for watching this episode on NRI Money Clinic. I shall be back with you on next Friday with one another thought on your life, your money.
Press the bell icon for more details and subscribe our channel.